Hey cousins, back with another video. If you watched my first video, you know I spent some time talking about my journey into trading, the ups and downs I've faced, and how it has shaped me to where I am today. If you haven't seen it, be sure to check it out. It will give you some context why I'm here sharing this information with you. In this video, I'm going to break down critical concepts about trading, especially for my beginner traders. Trading can be an incredible skill to learn, but it's important to keep in mind that most traders lose money when they first start. It's a tough learning curve, but remember this: strategy alone won't make you profitable. What truly matters is discipline and risk management. These two factors will determine whether you can become a successful trader or not. Another key thing to understand is that money you make in trading is a byproduct of your skill, not the goal. Many traders fail because they focus too much on quick money that they hope to make, which leads them to make rash decisions. Trading is not a get-rich-quick game. It's a skill that will pay you for a lifetime, but only if you take the time to master it. It won't be easy, but I promise it will be worth it. I'm rooting for all of you on this journey. Now let's dive into what today's video is really about: understanding the global markets and Forex. If you ever wondered where the money flows in the financial world and how the market works, this video is for you. To understand trading, you first need to understand how the global financial markets operate and how they affect currencies, stocks, and other assets. Historically, the value of money was tied to physical commodities like gold, formerly known as the gold standard. However, most countries have moved away from this system and now use fiat currencies, which is the currencies you know. Unlike gold-backed money, fiat currencies gain its value because the government says it does. It gives central banks greater control over the money supply, enabling them to create money out of thin air. While this system allows for a more economic management, it also means that the value of money is perceived and can fluctuate based on decisions made by financial institutions and the central banks. How money flows into the global markets. When money is printed, it stays local, then spreads throughout the world, impacting global markets in several ways. The US dollar is the most dominant global currency, used extensively in global trade. When the US government prints more money, it often flows into global markets, affecting exchange rates and creating liquidity in other economies. This ripple effect influences not just the US economy, but also other markets around the world. Printing large amounts of money can lead to inflation, which is the rise of price of goods and services. As money flows or as money enters the economy, the value of the currency tends to decrease, meaning it takes more money to buy the same item. For traders, this translates into fluctuation of currency values, creating opportunity and risks in the forex market. Additionally, currency devaluation can attract foreign investment as traders seek to buy undervalued assets. As central bank injects more money into the system, it influences a range of markets, including commodities, stocks, and forex. Increased liquidity can drive speculative investments, causing assets to rise. This may lead to increased volatility in financial markets as money moves in and out of different sectors based on market conditions. A significant side effect of an increased money supply is the creation of asset bubbles. When there is more money available, investors often look for places to park it, pushing up the prices of stocks, real estate, or even cryptocurrencies. However, these bubbles can burst if demand for those assets decline, or if central banks tighten monetary policies, leading to price corrections and potential market crashes. What is Forex? The foreign exchange market, commonly known as Forex, is the largest financial market in the world, with over $7.5 trillion traded daily. This is more than the stock market, commodities market, and all other financial markets combined. The beauty of the Forex market is that it operates 245, which means there is always an opportunity to trade no matter where you are in the world. At the heart of the Forex trading, currency pairs are Euro USD, GBP USD, and so on. When you trade Forex, you are buying one currency while simultaneously selling another. The goal is to profit from the movement in the exchange rates. For example, if you think the euros will rise against the dollar, you will buy the Euro USD pair, or vice versa. How is money made in the forex market? The way money is made in the forex market is through supply and demand. If more people want to buy a currency than sell it, the price will rise. Conversely, if people want to sell a currency, the price will drop. Every factor influences this, such as economic indicators like employment rates, inflation, GDP, central bank policies, geopolitical events like elections or wars, and so on. Understanding these factors can help you predict market movement, but it's important to remember that no one can predict the market with certainty. This is why it's essential to focus on your strategy and risk management. The banks and the institutions play a huge role in the global market. The next thing you need to understand is, what role do these banks play? While retail traders like us make up a tiny fraction of the total market, central banks, hedge funds, and large financial institutions are the big players that control much of the liquidity and the direction of the markets. The central banks, for example, have the power to affect currency values through monetary policies by adjusting interest rates, printing more money, or engaging in quantitative easing. This is why it's important to stay informed on global economic events. Decisions made by central banks can significantly impact on currency prices and the price movements. Although the forex market is the most massive market out there, right? It is not the only market. There are several other markets where you can trade, each of them with its own unique characteristics and benefits. For example, the stock markets. These are shares in companies where you buy a stock, you own a piece of the company. Stocks are traded on the exchange, like the New York Stock Exchange or the NASDAQ. You also have stock options. This gives you the right but not the obligation to buy or sell a stock at a certain price before a specified date. Then there's also cryptocurrency like digital assets, Bitcoin, Ethereum, and others. This can be traded 24/7. Crypto is a relatively new market and is really volatile. Then we have indices. These track the performance of a group of stocks like the S&P 500 or the NASDAQ, which include tech stocks. Trading indices lets you speculate on the overall market rather than individual stocks. You also have futures and CFD. Futures are contracts that allow you to agree to buy or sell an asset at a future date at an agreed price. That's CFDs, contracts of difference, are similar but allows you to trade the price difference between the opening and closing price without owning the underlying assets. I know I ran through that, but I needed to so I could get my thoughts across. Let's speak about what happens when a trade is executed, right? When you decide to buy or sell any of these markets, your order is matched with another trader's order through a liquidity provider. Banks and large institutions often act as these liquidity providers, ensuring that there's enough volume in the market for your trade to be executed. When you place a buy order, for example, you are purchasing an asset from someone who is selling. The price of the asset will move if there are more buyers than sellers. Similarly, when you place a sell order, you are selling an asset to someone who is willing to buy. The price will drop if there are more sellers than buyers. So I want you to know these few terms like lot size, leverage, and margins. You need to understand the key concept for anyone that is actually new to trading. These terms are crucial to understand. They directly impact your risk and potential return. Lot size, for example, this refers to the number of units you're trading. In Forex, there are three main types of lot size. It is the micros, the minis, and the standard. The standard lot represents 100,000 units of a currency pair, right? Leverage is a tool that allows you to control a large position with a relatively small deposit. For example, with a 1 to 100 leverage, you can control 100,000 with just $1,000. While this increases your potential return, it also amplifies your risk if there is a significant loss. And then the margin, this is the amount of money you need to keep in your trading account to hold a position open. It's essentially a deposit to cover potential losses. These will be covered in detail in further videos, but I just wanted to touch on it briefly. Finally, I want to briefly touch on the potential upside and risks of trading. Learning to trade and developing your skills can be incredibly rewarding. It offers freedom to travel anywhere, trade from anywhere in the world, unlimited earning potential, and a skill that can create long-term wealth. However, there are also risks. Over-leveraging is one of the biggest dangers in trading. It can lead to significant losses if you're not careful. Emotional trading, letting fear or greed dictate your decisions, can also lead to poor choices. Without discipline, your chances of success are slim in this game. That wraps up today's video. I hope this gave you a deeper understanding of how trading works. I know it was a lot, but I just wanted to give you a groundbreaking introduction to trading. Remember, trading is a skill that takes time to develop. Don't rush it. focus on learning and improving your skill, your discipline, your risk management. In further videos, I'll be breaking down the exact steps of placing a trade and managing your risks effectively, so do not miss it. As always, if you found this video helpful, like, subscribe, drop a comment. Make sure to drop a comment, right? And make sure that you keep studying, you keep getting better as a trader. And finally, make sure you remember to play the game to win. See you in the next one, guys. Peace.